Semiconductors, the brains of all modern electronics, from cars and phones to new technology like the Internet of Things and strategic 5G networks, have rarely seen such demand. Behind the scenes, Treasury and finance teams provide these strategic companies with complex supply chains, with the financial solutions they need to thrive. I'm Sarah Rundell from Treasury Today, and in our latest editorial podcast, I'm joined by Group Treasurer and Head of Investor Relations, Alexander Foltin, at Europe's largest semiconductor chipmaker, Infineon. Alexander, welcome. Could you begin by outlining your broad Treasury strategy, priorities and hedging processes in today's challenging environment?
Yes, happy to do so, Sarah, and thanks for the opportunity here to have this conversation. Clearly, we are going through interesting and quite volatile times. I think the fundamental pillars of strategy have not changed. It's about safeguarding the corporation's liquidity. It's about ensuring access to a broad array of funding sources, mostly diversified funding sources, and managing financial risks appropriately. So as we're going about this, we are obviously living in a low to no interest rate environment, or rather negative interest rate environment, at least in the Eurozone, which has, let's say, pros and cons to it. Of course, it's challenging to manage the liquidity. We opted, as Infineon, for giving cash preservation the priority, which means we do incur negative interest yields or rates these days. On the flip side, it's a relatively benign environment for funding costs. And as we have been going through the largest and most transformative transaction in our corporate history, namely the acquisition of a US-based peer of ours, Cyprus Semiconductor, which we acquired for 9 billion euros last year, that is actually the more important part of the equation, that we have access to, relatively speaking, affordable funding. So priorities for us is to navigate through this environment of, let's say, volatile times, of underlying businesses that have seen quite a bit of gyrations, disruptions last year triggered by COVID, a rapid V-shaped recovery in most of our markets last and this year, and how we go about it. Looking into the future, the next, let's say, thing to watch from our point of view is the price levels. So we look at inflation risks. We are not yet actively hedging them, but we are certainly watchful. In terms of interest rates, we have hedged some of them, looking at our refinancing agenda. So we locked in, but only a part of the interest rate. So we actually choose to hedge 50% or less of the expected exposure, with which we actually fared well, given that market rates thus far took another drop from last year's highs. Commodity side is something that Infineon generally does not hedge, given that the base metals that we need, such as copper, aluminum, etc., tend to fluctuate with the overall economy. In other words, when we see rising input prices, that's usually a point in time where we also, let's say, have good momentum on the business side and can adjust our output prices accordingly.
You mentioned Infineon's 9 billion purchase of US chipmaker Cyprus Semiconductor in 2019. Could you talk a little more about how you structured the financing here and the key considerations in that process?
Our company, let's say, is structurally cash positive. That means that funding needs are really created by transformative events, such as a large-scale acquisition. Cyprus very perfectly fits this bill and is a good case in point. 9 billion was, at the time we signed the deal, actually corresponded to about half of our own market capitalization. So that put things into perspective. And you see from this that we are really talking about something big and transformative here. Our key pillar in terms of thinking about financing structure is the investment grade. So we actually spend a fair amount of time and care involving also our rating agency upfront in discussing various financing scenarios and actually running a couple of these cases by them in order to be very certain what we needed to do in terms of equity debt mix to come out as an investment grade company. Going into the transaction, Infineon had a capital markets rating of BBB flat. We have, at the point of closing of the transaction, been downgraded by S&P to BBB minus, which is also our current rating. In other words, we have managed to stay within the investment grade. We have achieved that by a mix of debt equity funding of about 1/3, 2/3. We put in the equity first, 3 different transactions, 2 straight capital raises or share placements, 1 issuance of a hybrid bond, which in our case, as we have structured it, is accounted for as equity and also receives equity credit from the rating agency. The rest, the 2/3, came from debt financing. We tapped the European bond market first and very recently have issued or printed a US private placement, so filling with capital markets the debt portion that originally got funded from our commercial and investment banks. Meanwhile, the rating agency has actually put us back on a positive outlook, so there is the perspective of returning to the BBB flat scenario that we started with. So when I say 2/3, 1/3, it means that of the 9 billion, roughly 6 billion coming from the debt side, and that's where the interest rate environment certainly did have a lot of, let's say, impact in terms of bringing funding costs down. We have funded ourselves all the way up to 2033, so for 12 years now. And certainly the 10 or 20 basis points different here is something that is felt throughout such a long period of time.
Could you talk a little more about why preserving your credit rating was such a priority? Was this the most ambitious deal your team has ever done?
That is an absolutely fair statement, Sarah. I mean, the company here is 20 years old. We got carved out and IPO'd from Siemens back in 2000, went public under the name of Infineon, and since then, this has been the largest transaction actually by far. The second largest was 3 times smaller when we did it. So in that context, the investment grade rating really was pivotal for us. Not even in the first instance to guarantee affordable funding costs, but in the first place to have access to the funding, to get the sheer volume necessary to actually fund this acquisition. So for us, it was quite visible that in sub-investment grade, you run the risks of markets being either temporarily or totally closed and unavailable. One case in point is the bond buying program of the European Central Bank, which has helped us and other companies funding or guaranteeing a stable funding mechanism throughout the period of the pandemic, because the buying mechanism, and you have the equivalent also from the Federal Reserve in the US, is open for investment grade rated companies, and as such the ECB certainly played an important role in building our order book at the time of last June when we issued the first Euro bond under our newly established EMTN program. We raised 2.9 billion. In doing so, the order book was almost 5 times oversubscribed at that point in time, and a good part of the demand certainly came from investor universe that was keen on having investment grade rated paper, and especially the lower part of the investment grade spectrum in the low interest rate environment that we discussed initially was offering a good balance of yield and security. So from our point of view, that drove the decision, or that's why investment grade is such a key aspect for us. Having access to funding sources in the first place, and in second priority, bringing down the cost of the interest cost.
Yes. Could you talk about how your banking relationships supported this process and what you look for in your banking relationships?
Commercial and investment banks, or global banks at large, are certainly key business partners of Infineon. In our case, probably a special point of departure was that we did not have an established set of core banks going into the transaction. Different from many other companies, from other corporations, we did not have, for instance, what's known as an RCF, or revolving credit facility, which you typically have in place, so you ex ante establish a set of core banks. We certainly did have our network of bank relationships, but nothing firmed up. So when the transaction came along, there was, as you can imagine, a small set of banks involved on the M&A side of the deal. We made it very clear that we expect them to also provide committed funding. So in return for a lucrative M&A advisory mandate, they had to chip in and let's say put their money where their mouth was, and guarantee or underwrite the initial transaction. We then, within 3 weeks after signing, syndicated the financing out to what in the end became a consortium of 20 global institutions. So we basically established now a set of core bank relationships, or a network of key banks by virtue of this acquisition financing. We were clear and transparent what we were looking for from the outset. Committed funding across both a bridge facility, so that was a comparatively short-term financing, as well as a set of so-called term loans, which stretched the way all the way up to 2024 in their maturity. In return, our promise to those banks signing up for the financing was that we would allocate the takeout financings among them in a competitive way. That is also something that is bespoke, I would comment, because typically what you have is that the initial underwriter take the largest piece of the cake, and everything else is more or less pre-allocated according to ticket sizes in the syndication. We did this a little bit differently, so we have most everyone there in the consortium on an equal footing. In other words, whenever a project comes up, be it equity-linked, debt, euro, US, what have you, our team receives pitches from those banks that we deem most relevant for the specific financing projects in question, and then we actually do a little RFP project each and every time a refinancing comes up. That is, on the one hand side, a bit more laborious for both sides, banks and ourselves, or by the same token, we assure this way that we get best service from a highly motivated set of banks. So that's how we created or built the bank relationship group via this, you can call it relationship defining moment of the large acquisition. And given that we are not entirely through now with the refinancing, the bulk of it has been done, but still there is some more financial wood to chop, you can say. This is also the way we go forward, looking to the future way dealing with banks.
That's very interesting. How do your larger banking partners feel about being put on this competitive footing with smaller banks?
I would say there are certainly different views. If you ask different people about our approach, we think it's fair in the sense that, let's say, the ultimate commitment is the same. So whilst there have been an initial underwriting and a certain initial risk that the M&A advisors took, that has been, let's say, rewarded also with the M&A advisory mandate. Following the syndication, most banks are on an equal footing, and those that are in terms of their commitment. And that creates, let's say, a level playing field for everyone to compete. And actually, if there was a kind of quarrel or complaint raised, my response would be that the banks typically think highly of themselves and regard themselves as highly competitive. So that's actually the fair chance of proving their worth. And so far, I have, let's say, the impression that everything was held in a very competitive spirit, but that's the way it should be.
I'd like to talk now about the global chip market. Infineon has its own in-house manufacturing, but also has to navigate tight supply from contract manufacturers like Taiwan's semiconductor manufacturing company under its outsource model. How does Treasury support the company as it navigates the current supply-demand dynamics in the chip industry?
So there is right now the backdrop of both a strong cyclical recovery as well as a structural upturn where the industry thinks it will be a multi-year topic. Now for Treasury, obviously, this brings with it several challenges. On the one hand side, semiconductor manufacturing is a quite capital-intense business. Yes, you can outsource to manufacturing partners, the so-called subcontractors and foundry partners, but there are limits to that. And the current chip shortage is in large measure due to the fact that there is not enough foundry capacity available on the market. So for someone like Infineon, who has a comparatively high share of in-house manufacturing, this is, let's say, a situation where we fare relatively well. However, we have to find the financial means of supporting our growth track. I would like here to come back to our situation as an investment grade rated company. I previously spoke about keeping open avenues to financial markets in order to have access to funding. What we also do is we run a fairly high strategic liquidity position. So as Treasury, we certainly, in our case, do not optimize in the sense of bringing cash down to bare operating levels. We want to have the financial flexibility and freedom, especially throughout cycles and especially in down phases, to be able to proactively invest, because that is almost a law-like certainty that semiconductor cycles do return to upswings, and when they do, you want to be part of it and have available capacity.
What is Treasury's role in working with Infineon's customers to ensure a smooth supply chain?
I spoke about the role of foundries and subcons. Currently, what we clearly see is that the scarce capacity is allocated among customers, we being one of them, in a way that also demands are created for things like down payments or even co-investments. So there is an interest on the foundry side to share the risk with customers. And actually we can mirror that also, as we are still quite early in an overall long manufacturing or supply chain. We can mirror that to our customers. Clearly we likewise have the interest that orders coming our way from various end markets, be that automotive, industrial, consumer, communication, etc., have a high degree of reliability. So to the extent that reliability can be underpinned by co-investments, down payments, we have so-called capacity reservation agreements which we offer to customers. So if a customer wants to insure against the risk of lack of capacity, there is the opportunity to also make these capacity reservations and put some money up front for us to have kind of burden sharing here for the investment. But that goes both ways, so it is on the supply side as well as on the demand side applicable these days, and Treasury is kind of in the middle of it, brokering the deals, looking at financial risks, of course safeguarding the company's liquidity position, making sure that the rating is kept, which is not an end of it in itself, but rather a means to ensuring broad access to funding. So yeah, we certainly participate and do our share to, let's say, help over time debottleneck a scarce situation.
How have your customers reacted to committing ahead rather than relying on just-in-time delivery strategies based on their own fluctuations in demand?
I would say there is a general realization of what the value of a resilient supply chain is. That is certainly one lesson the COVID year 2020 has taught us all, that delivery certainty has a high value. We always say the most expensive chip is the one that you cannot produce, and you certainly don't want to have line downs, for instance, for 40 to 50,000 cars if a 4 or 5 euro or dollar component is missing. So in that situation, clearly there is a common perception that we collectively have to firm up the certainty of supply. So clearly, I mean, these discussions are not always easy, but there is an understanding that the capital-intense nature, especially of our business, and the cycle times that you have. And cycle times here you have to consider on 3 levels. The one is how much time does it actually take to manufacture an individual chip, an individual component. That can be 12, 14 or 16 weeks. The next level would be how much time does it take to bring on additional capacity if you have clean room space available. So if you only have to procure machinery, hook it up and install a new production line, that could be with current lead times anywhere between 6 and 12 months. And how long it actually takes to bring entirely new capacity on stream if you have to build a fab. So if you have to build a clean room, which is a multi-year endeavor. So in that sense, there is a certain understanding that burden sharing needs to be done here.
Alexander, thank you so much for such a fascinating insight. You've been listening to an editorial podcast with Alexander Foltin from Infineon and me, Sarah Rundell. Don't forget to subscribe to the Treasury Today podcast channel to get further episodes in this series. You can find us wherever you get your podcasts.